So hello and welcome you here to today's special webinar, Discover Tactics of a Pro Trader and how to trade the market opening of the US markets. My name is Jens Klatt and I'm exclusively presenting this format to you for JFD Brokers. And in fact, I can already tell you the following. Since last week, Tuesday, I hadn't had any trading signals in my S&P trading approach. So you may remember that I have a trading filter here where I say I want to see a trading range, an open range of at least 5 points. And you may have also seen that this was very difficult to achieve. But today, chances increased dramatically. So you have seen probably the DAX long or short in the morning. That was another format, which is usually taking place every Monday and every Thursday on the YouTube channel from JFD Brokers. And there I formulated a trading setup which worked out really well. It was a short setup, and you may have seen what happened in the DAX in the morning. So it was a good catch, even though we only had an open range here of something like 21 points. Yes, it was 21 points. The market broke significantly on the downside and then accelerated here hugely and was traded in the low around 12,900 points. And so my idea was that we aim for a target 12,970. Obviously worked out really well. So initial risk of 21 points, and then going here short, by the way, on 1321. I'm sorry, 1328. Aiming for 12,970 makes 58 points reward on such a trade. Risk reward was 2.7, 2.8 to 1. So all in all, worked out really well. Again, accelerated massively on the downside. And in fact, if you look at the hourly chart, and this is, by the way, we will have a look at the US equity markets here in a few seconds. But I also want to make sure that you see the significance of the region around 12,900 points here. So this is the region which I mentioned already several times during several morning meetings here, and also in those DAX long or shorts webinars. And I think the moment we break below this level, there's further room on the downside, which could easily push us as low as 12,680, 12,700 points. And the thing is now, and that was already something you could see in the morning in the DAX, and we are, or some bulls, let's call it that way, some bulls should be really scared that we get to see a real sell-off here in the US equity markets too. So I'm not a huge pessimist or something like that, and I say, well, we will sell off hugely here in the afternoon with the US markets opening. But I tell you that I think we are not yet done. And if the DAX pushes to these levels, 12,900 points, there is room for another 200 points, easy 200 points, as you may have seen in the morning already when the market accelerated here on the downside and made easily 120 points in really no time. So if you look here at these conditions, when we broke out of the open range, you can see that here from 9:45 German time, that is 7:45 a.m. GMT, we pushed here 100 points in like 10, 15 minutes, 20 minutes. And this is usually happening once the market is, as it is currently, once the market is underinsured. This is something you can see in the case of the DAX, the VDAX new. This is the volatility index on the DAX. This is similar to the VIX you can find on the S&P 500, which is currently, by the way, spiked up already. One sec, by the way. Let me just open a tab here for you. So we'll just open the VIX here, and then I'll show you the, I'm sorry, that wasn't good. Or, okay. So I'll show you the VIX here. Takes a little. Okay, let's wait. Let's open a German website here too. similar to Bloomberg, but there I know where to easily find the VDAX new. So, and the future. So we are already open, and you can see that we trade significantly above 10 already, which means we're trading above 11, by the way. And here you can see it's an overnight trading taking place in the US then. And when the European markets came in quite volatile, and we saw this mini sell-off, let's call it, in the morning, VIX spiked higher too. The same thing you could see in the S&P future and the Dow Jones future. You can see that both markets were hit quite hard too. And oh, by the way, here you can see that we are nevertheless still very, very volatile here, meaning the market is uninsured. Volatility is nothing more than the Vega. Is it called Vega? Vega. It's VEGA. So it's the Greek letter here for V and showing volatility. And it's a very important component in the option pricing model. And the VIX is calculated based on those on those V's. Let's call them V's. It's not Vega. I'm not very sure how it's pronounced in English. And so you extract. Yes, you extract this component out of the options here, and based on that you calculate the VIX. The same thing is done here for the DAX here with the VDAX new. And the thing is that based on that, you can see how, oh, that's interesting. And based on that, you can see here that the market usually buys volatility once it's getting unsure about what to expect. That's probably, or the perfect example can be seen here. That was shortly before the election in France. And if you go back 5 years, in case of the DAX, then you can see that was a huge spike here, for example, right before the Brexit in 2016 in June. And usually you see those spikes on the upside once the market plans to insure itself against bigger moves on the downside. And in this context here, the thing is that such least volatile levels here, or low volatile levels, they perfectly illustrate that the market is not buying insurance right now. So once an event hits the market, which no one sees coming here, there's usually panic happening then. And if you combine this with a thin market with a thin market environment, you can easily understand why the market right now, especially the DAX here, but also US equities, is definitely not yet safe on the downside. But if US equity markets come in here bearish, and if, for example, let's say the Dow Jones starts a corrective move, and by the way, to just give you an idea of how extended we are on the upside, have a look here at the RSI 14. So it's, I mean, obviously we should be overbought somehow. If you look at the current market conditions, and if you see how aggressively we pushed higher here right now, pushing over 1,205% from the 11th of September here, higher to new all-time highs. And there was nearly no real day when we didn't have a new all-time high. I think it was the 15th time or something like that that we hit, 51st time that we hit the new all-time high yesterday. And the thing is that the market is very optimistic right now. It's hugely underinsured, and here we can also see that it's usually extended on the upside. So if or that said, let's have a look here at some statistics. Perfect. I don't even need to go over to my Twitter account, but I can easily here go with Stephen Burns and his chart. I retweeted the same chart. So you can see here that if you go back to 1917, you can see that it hasn't been that often that the RSI presented itself that overbought as it does right now. So no big coincidence. If you look at this run here during the last days and weeks, well, this is no big surprise, but it shows that the risk rewards here on the upside are getting more and more unattractive. And now the thing is, if US equities finally start moving lower, because the market participants just drop their position. So look at here, for example, the S&P. We will definitely come in significantly below the lows from yesterday, and significantly means really significantly. I mean, when I introduced this webinar, I just told you that I hadn't had a trade here back to last week, Tuesday, meaning we hadn't had an open range of 5 points or more than that till last week, Tuesday. So that shows that the market itself is really, really volatile. And you can definitely say, okay, if we right now open here around 8 points below the lows from yesterday, so the green line shows the lows from yesterday in the S&P here, a 50-minute time frame, you can say this is quite a huge gap. And in fact, I'd say right now, I don't have any statistics here, but I'd say it's not likely that we'll close this gap. But instead, probably market participants probably come in and will probably start to dump some of their long positions here. We know that market participants here positioned themselves to profit from this move higher or leverage their positions by buying equities, and on the other hand, shorting volatility. So right now, probably here, this drop was just, or it just gives a small taste here, or a first taste, what could happen if now those market participants keep on probably reducing their position. The S&P itself, and now we have to switch over to my Twitter account. The S&P itself hasn't seen a 3% drop here. So we are about to set a world record, by the way. We haven't seen this before. So here, that was another tweet from me in the morning, a retweet here. We have not seen a 3% corrective move in the S&P now for 239 days. So we need 3 more days to make sure that this is the longest streak without a 3% drawdown. I'm not saying that we are here now seeing a 3% drawdown, but chances increasing. The longer such a streak takes here, the chances increase that we'll finally move lower here. And if we combine all this, low volatility, which probably will spike higher on any bad news hitting the market. We have low volume here. We have a hugely extended market on the upside. You can understand now opening with a sharp gap lower here, obviously. So it's only 15 minutes left, and it's not that likely that we'll make those 7-8 points here to close this gap. Probably we'll see a gap close, but somehow I have the feeling that it's more likely that we'll probably open lower, or probably there will come sellers into the markets. And I mean, we have to see whether this really happens or not. And after the first 45 minutes of trading, we'll then formulate our setup. And probably we are on the long side. That has to do with the fact that we are then trading above the exponential moving average 10 here on a 50-minute time frame, because I'm only going long. I'm going long in case of the market trading above this yellow line here. But my personal take here, in fact, is to avoid long engagements and instead look for short engagements. By the way, I present to you something. I prepared it already here to give you an idea of how to work with this in your trading, because I myself, I'm short. So I'm not short the S&P, but I'm short the DAX here. But I'm not short from the morning onwards, but I'm short since yesterday already. And in fact, in the morning today, my system I'm trading, it's an automated system, and there is only the chance of a discretionary intervention from my side to switch it on and off. So the market decides whether it goes long or short in the morning based on some statistics I worked out over several years. It's more than a decade, in fact. So in the morning, there would have been a long signal generated, but I took off the system, and in fact wasn't the worst idea here. I wouldn't have been stopped out so far. That's a fact. Nevertheless, I saved some nerves, let's call it. It would have been a close one here, and yet I think we are not yet done. So there's still a chance that probably there will be a move lower then. And in fact, yesterday I had also a short position on, which didn't work out that well. Even though we had a squeeze here, that looks more dramatic than it was, in fact, because my stop was placed another 60, 70 points higher. So the position size is significantly reduced here with this approach, and it's a volatility stop I'm working with. And so the position was showing a small loss yesterday, but I took out the system. I said I take out the system. I switched off the system yesterday in the evening. I said I hold on this short position, and I'm not willing to take any long positions today. That was just a feeling. It was a gut feeling, and in fact, it was 2 minutes before the market closed. And I just did it, and it worked out really well so far. And I will show you how significant such a discretionary approach can be here. But before we do that, first of all, let's again formulate an idea of, by the way, can we? No, I haven't. We will formulate an idea also for the DAX, what could happen here around 12,000 and 12,900 points, and probably also formulate an idea of how to trade this region here. So we've already seen that this is a quite significant region, and so in fact it's very easy. What we could do, what we should do, what I do, in fact, or if I want to place another short order here, I just go short here with this break lower. That's it. Easy. So that was here around this low probably, which is currently, let's just have a look here. I think it's 12,924, 25. That's the entry here, and then I just see where to place my stop. So probably the setup would look something similar, saying I'm shorting 924 and place my stop on wherever now this low. In this case, it's a swing high. By the way, it's not a low; it's a swing high. Would end here. So let's go. Just do the following. That's probably a little better. I do the following. I just say, okay, I short this level here, I place my stop here at this level, and then enter the short here and go for a break of 12,900 points. The good thing about this is it definitely takes some bearish power here to trigger this event, or to trigger this level here. So the market has to move another 40 points lower, and it won't happen in a few seconds here. Usually it won't happen. Let's say I'm not sure whether it will happen at all, but it usually won't happen in a few seconds, and we have to wait how the US markets present themselves. But, and this is the thing, I think if we are triggered here, and if the market really attacks this level around 12,900 points, then we definitely have some further room on the downside. And let's just, I mean, it's difficult to say now where the market will top out here, and where the stop will be placed. But let's put it that way. The setup here, short setup, let's call it, has the following parameters. It is an entry short at 12.9. Let's call it 25. We put the stop 40 points higher then. So currently it's 12,965. It's 40 points risk. I'm not yet, I don't really know whether it will really 965. It could be that it's slightly higher or not, but just to show you here how to calculate a risk reward. By the way, it's not Risiko, this is a German word, but we'll call it risk here. And then we go for the target, and we call it 12,680 to 700. So the question you might have is, reward, why this region? I can show it to you, one sec. So it's reward is minimum 225. So we're going here from 700 up to 925. And then you can already see that the risk reward is really, really, really attractive. So it's 1 to 5 around. Even better than that. I mean, it's bigger, 1 to 5. And this is the setup you could calculate for the DAX. Not sure whether it will be triggered at all, and not sure whether we'll reach this target here in the upcoming hours. But the thing is, if the US markets really come down, I would expect the move to be quite aggressive. and really extended probably, and this easily would give us this chance here that this region is reached even today. So let's just see whether this happens or not. But right now, you might say, well, aren't we yet done here on the downside? Probably we are. Not sure. Probably we are. But somehow I have the feeling that right now we should definitely watch out and be aware of the fact that if we break below 12,900 points, and if the US markets really come in weaker, that especially the DAX has some huge potential on the downside here, which could easily push us as low as 12,680 to 700 points. And this is, by the way, also, it could also be triggered by the Euro USD, by the way. So just have a look here and be aware of the fact that the strong Euro here over the time span from June till here, the beginning of September, was the main driver for the DAX here coming down from around 12,950 back then, and that was shortly before we triggered. Then no, that was shortly before we moved up to 30,000 points. We didn't make it to this level till 4 months later, and from there the DAX really moved lower and fell also below 12,000 points, while US equity markets, for example, just pushed higher. They didn't even look at what was happening here in the DAX. So, oh, by the way, I just said June, right? Is it June? I'm not sure about that. Yeah, it's June, right here. It's June till the end of August. And look at what happened here in the Dow Jones during that time span. It just stabilized a little, moved higher. Stabilized, moved higher. The DAX now made also new all-time highs and pushed aggressively higher, even more aggressive than probably the Dow Jones did. But all in all, we have to say that the strong euro definitely weighed on the DAX. And now we see the DAX outperforming everything, even though the euro is still trading at a quite elevated level and above 118. So this could also weigh on the DAX here and trigger some further weakness then. And yeah, it's definitely worth a watch, definitely. So that's something we'll closely watch here in the upcoming minutes then around the US market, US market opening. And on top of that, we'll definitely watch out for potential, hopefully short setups here in the S&P. So one sec, by the way, I just have to check something here. Okay. Good. Okay. So that's it on the current situations and my current view here on the equities. Let's just see if it plays out or not. Again, you can see it here. So it's not that significant, in fact. So on the daily chart, I would say, well, is it so significant? Let's see. But you can definitely see there's lots of room on the downside, and from a risk reward perspective, could be really, really interesting. Again, so that's again in terms of the DAX. Now, I just want to present to you the following. I promised it, and now I want to present to you something, because and now let's probably let's put it another way around. 1 second. So here again, this is the risk disclaimer, and here's the setup of the and that's where we come to the US market opening here, by the way. So let's have a look here at the strategy itself. So it's easily duplicable. It's easily you can easily automate it, in fact. And so it's just 3 steps: your definition of the open range breakout setup, how I trade it, and how you can also somehow see it here in the S&P. Where do you have it here? It's in fact, it's very, very, very easy. So you just wait for the first 45 minutes of trading, where you then define the open range. You look at the high and the low. What I didn't include here, because it's a discretionary component, where it's trend filter, where no, it's a trading filter. It's such a trend filter itself, but it's a trading filter. I just I put it in this approach here. I say, well, I want to see an open range of at least 5 points, and I know that it is profitable. So in fact, it is. I already want to show to you here a chart. One sec, I have it here. I've presented it already several times. So here, if you backtest this approach, hello? Here. If you backtest this approach for 7 years now, so till November 2010, you can see a clearly positive equity curve with a very simple approach. So this is the equity curve with a filter of 5 points here, by the way, if you only trade this setup. So it's definitely a profitable setup with a positive expected value over the last years of trading, 7 years of trading. And but no, nevertheless, the thing is the following: you can easily take this here and trade it, but the job of a trader, at least, isn't to just take a setup and then say, okay, I take this setup and I only trade it. But usually it comes to, and this is what trading in fact is about, and many of the other expected value games, let's call them too. By the way, what's going on here? Okay. So what it all comes down to is you have to optimize the expected value. That's probably something we'd call in the hedge fund industry, we'd call it finding the alpha, if you want. So it's really, this is sometimes, or now most of the time, it's skill oriented. And the target here is to make sure that the positive expected value, which shows that you're making money with this approach and making money in your trading, and you are profitable in your trading, and where the expected value here is defined as the HR, which is short for hit rate, and then the average gain, and you subtract here the a product of the loss rate, LR, and multiply it with the average loss, that you somehow try to increase this part here, making the hit rate higher, bigger, or the average gain bigger, while you try to reduce the loss rate, respectively, the average loss here. And that way, try to somehow increase the chances, not just of being profitable, but even more profitable. And that said, you can take the numbers here from here, the average profit, average loss, the win rate, and then just fill it in here in this formula and find out finally, the payoff ratio, by the way, is the ratio of the average gain and the average loss here. Okay, it's 108, and you divide it by 0.82 here. And the payoff ratio then is 1.3 to 1. And if you put in those numbers here in the formula on the expected value, what you find out is that the expected value is 8 cents per euro you risk. That means, let's say you're risking 100,000 euro on a 100,000 euro account. That means nothing more than you're making on average 80 euros per trade, no matter if you're winner or loser. So you have a positive expected value, and you just have to trade through. And at the end, if you can stabilize those parameters here, the hit rate, the loss rate, the average gain, and the average loss, well, then you'll come out ahead and make profit here. That's usually what you get out of such a back test. Okay, so now you look here at the following. You look at the account size and you say, okay, I'm trading 100,000 euro account. You risk 1% per trade. That's 1,000 euros. If you multiply these numbers here with the average gain, respectively the average loss, you get a clear number of what to expect if you lose. It's 820 euros on average you lose, and what to expect if you win, the average gain, which is 1.08 here, multiplied with 1,000, which is 1,080 euros. So all in all, so far, nothing big happened here, but you can already get a good idea of what I'm talking about if I say try to optimize your expected value. So what I'm talking about is the following, and here, let's have a look at an actual example here. So there's the opening, by the way. So now you can see it. It's 2,549. And so far, the market already pushed higher here around 2 points. Okay, so usually that should also result in the DAX now performing on the upside, but that has no real meaning so far. So the market really has to show that it wants to push higher here. So let's see, what is the DAX doing? Yeah, exactly. So the DAX is also shooting higher. Question is, can it really push significantly above the highs which were built here in this region? So it's way too far, too early to say whether now we are done on the downside. So the setup is still given. The only problem we have right now is that we have to adapt it a little. So what we have to do is we have to probably place the stop a little higher, which will reduce our risk reward. But as you can see, we have to even if we have to place the stop 100 points higher, that would be 13,025. We still have a risk reward of 2.25 to 1, which is still quite attractive. So let's just see. We have to be a little patient here, just see how the market present themselves. And I wouldn't be surprised if there's some selling pressure coming in the US equity markets too here. And if the DAX really can't stabilize here around the current levels, probably pushes lower. But just let's see. So what I want to show you is the following. So I have a trade on now, which is purely automated. Okay. So no, let's do it that way here. So I have a trade on. I place it here. And this trade says I'm right now the DAX short yesterday. Okay. So, and then today, X would be traded long today. Okay, so fair enough. The thing is that I decided yesterday to, mainly based on what I've already presented to you. So have a look here at how extended the market is. And it's not just the DAX being that extended, but it's also the US equity markets. So rather sooner or later, there will definitely no more buying pressure, huge buying pressure coming in, which is capable of overcoming the selling pressures and those who are willing to sell equities here. Because the risk reward is getting more and more and more and more unattractive. The higher the market moves, the more unattractive it gets. So let me just illustrate this here probably with a small picture. So let's look at this. I mean, if you have a sequence of higher highs and higher lows, then usually you can read in many books that it's worth, or that it's definitely something you should take into account, buying the dip. So meaning if the market retraces for a certain amount, however, and how big this might be, it doesn't matter. But just imagine the following, pushing back here, then it's a usual saying that means, well, buy the dip. And this is because if you place the stop here and the market really moves to new highs, that usually this is giving you a way better risk reward. So this is the R, the risk you have, and this is the chance you might then be given here, and it's more attractive to have. So I call it chance. It's not another R for reward, but let's take it as C here. But just imagine the following: you're now going long here once the market breaks to new highs. The problem will be that the risk increases. So this is the risk then, while the chance will be reduced. And usually that's the reason why you usually say buy the dip and try to trade into the retracement. So now, the thing is the following. The higher the market moves without showing us such a retracement, the higher it moves, the higher it moves, the higher it moves, the more unattractive it gets for the market participants to buy. Since the higher the market moves here, I mean, the more likely it is that there will be rather sooner or later a corrective move. Even if it's just a small move, that doesn't matter. But the thing is, you don't want to buy here if you can expect the market to at least show you a drop of, let's say, 20 to 30 points. So you usually, if you're rational, and usually people, even in the, no, I won't say that because it's not true. Usually cognitive biases and all this stuff. So, but the thing is that usually you'll then say, hey, I try to catch a move of 20 points lower or 30 points lower. So usually that will here with the rising price, you would usually say, no, I don't want to buy anymore. That's really what I want to say here. And with this in mind, you will usually say, you know what? Chances are increasing that rather sooner or later the market will push down. The thing is, I mean, you could have easily said this after we broke above here those July highs too. You could easily have said this. And then you could easily have said at tier 2, there was no pullback. You could said it here when we finally did it. Now we have the pullback, but you can see that the markets can stay longer in those areas here, as you might guess here in the first glance here. So, but now the thing is that yesterday I decided to say, okay, well, I take out my system here, which usually generates a long signal in the morning, in the next morning, while I hold on my short position. Again, my short position had a clear predefined risk, so I wasn't taking out any stops here or something. So don't get me wrong. I just took out the automatism here, taking out my trade automatically at the end of the trading day. So that means here, if you want, I just said, you know what, I just take out the system, I leave this trade open, since I have enough room on the upside, and I don't want, by the way, I don't want to face a loss then here, because yesterday, this trade, the DAX short, showed me a small loss of something like 600 euros. That was around what I had to expect, in fact. So I had an average loss here. Usually these numbers are based on this strategy. So right now I'm talking about another strategy, but I have the same for my strategy. And I know that the average loss is something like 600 euros, depending on how much I risk. But all in all, that it comes down to 600 euros here. And this is the great thing about this. I didn't take the loss here. And now today, obviously, the trade is showing a profit. In fact, I don't even have a risk that this trade will show a loss for me anymore, because I already moved the stop to break even for my approach here. So the thing is now, what happens if I'm getting stopped out, or if we are moving lower, probably here, and that would be the great thing, by the way, that the market pushes below 12,900 points now in the upcoming hours. Or tomorrow, probably I'll leave this trade even open overnight again, and probably go for another short lower tomorrow. But the thing is that I can already say that I minimized my loss on this one trade here, resulting in an optimization of my expected value, positive expected value. So because I not just increased the hit rate, respectively reduce the loss rate here. So I'm not facing a loss trade anymore. This is something, well, losing trade anymore. This is something very important. But I also push down here the average loss. So meaning, all in all, I reduce here this part of this equation, meaning I reduce the part I subtract from my from my hit rate multiplied with the average gain. So this is the first thing I achieve here. And now the second thing happens. I not only did this once, but I did it twice, because I didn't go long today too. So I switched off the system here based on my personal market analysis I did. So I'm not kind of guru telling the market, now you've moved high enough and that's why you have to come down or something. But I just guess it's still a risk that I'm on the wrong side. And just imagine the market shot higher today too. I would have faced a loss on my short trade, and I wouldn't been long tier 2. So that's always a two-edged sword. But the thing is that somehow there was something telling me, just give it a try. I think the risk reward is good, and if you do this often enough, you'll come out ahead. You definitely be on the right side here if you do this more and more often. And so it worked out so far. And now the thing is, look at this, the DAX long here today. I didn't take it, and the great thing about this is, so far, if you look at the current numbers, if I'm not mistaken, it must be somewhere around minus 100 points here too. So it's not just that. Let's just assume we close the market right now. Then I will make a profit on my trade from yesterday of around 60 points. That will be a profit I have. I save those 45 points from yesterday, which where I would have realized my loss. That means on the short trade, there's a difference of 100 points around, and then I'm saving another 100 points here on the long trade I didn't take in the morning. Meaning I just have a better result of 200 points on my already positive expected value, meaning I'm optimizing my positive expected value here. So for some of you, that might very well be not just complicated, but some of you might say it's purely theoretical, right? Does it really make sense? Yes, in fact, it does. Because, and now you can perfectly see why I present you all these numbers and why I always emphasize to have a clear set of predefined rules you follow, and where you know that you already have in the basic version a positive expected value. Because if you don't have this, you just don't know where you stand, where you really stand. If it's a good trade or if it's not a good trade, if you just optimize your expected value or you didn't optimize it. And that's why it's so important to have all those informations available. And this is exactly why I feel so confident in my trading and why I'm completely relaxed. So some people just told me, that I'm really enthusiastic about when I talk about trading. And I have to be honest, I really love what I'm doing. So I really love the markets, even though they somehow or sometimes give me loads of pain. But the thing is that all in all, I just love the markets. Nevertheless, that doesn't mean that I'm very enthusiastic and excited and nervous and I don't know. Nervous, excited, whatever, when I'm trading. But usually I all the time know what I'm doing, and I'm really relaxed here. I just sit here and try to optimize the expected value. I know that if I keep on doing what I'm doing, I usually will make money in the long term. I can't avoid it. This can't be avoided here. But on top of that, I really try to optimize the expected value here, and then just calculate. And then just calculate whether what I just did was good or bad in terms of my expected value. And if it was a good trade, it means that I just optimized the expected value. And the outcome of the trade and what I just decided to do brought me or will bring me more money in the long term. And that's usually what trading is about. So trading has nothing to do with calling the direction of a market or something like that. I mean, yes, somehow it has. If you look at the formula here for the expected value, you might say, hey, it's a hit rate, right? If you can call the right direction of the market, yes, you're definitely right. And sure, if you have a hit rate of, let's say, 100%, you're never wrong, and you can always call the right direction of the market. Well, you'll usually subtract 0 here, because if you multiply 0 with whatever average loss you might face, well, you definitely have a positive expected value. If the average gain is only, let's say, 1 pip, 0.1 pips. And if you have a good commission model, which you will usually find at a broker like JFD Brokers, then that you will definitely come out ahead. But all in all, this formula also shows perfectly why it's so important to let winning trades run and cut losing trades short. Some of you probably can't hear it anymore, because you just open a trading book and you just read exactly that. Let your winning trades run, cut your losing trades short. But I bet that most of the people out there never really ask themselves, why is that? And it's because of this formula. It's probably the most interesting, most important. It's not interesting, it's also interesting, but it's more important. The most important formula in trading. That's what it is. And that perfectly shows, if you make your winning trades big, so meaning you make the average gain big and let winning trades run, while you try to reduce and cut your losers short, in the long run, you will increase your expected value that way and turn out a profit in your trading. That's it. That's the only real secret. I should have called this webinar probably "The Secrets of Profitable Trading," and then only presented the formula to you, and then just ended the webinar, I don't know, after 2 minutes or so. But this is exactly the thing why this is so important to not just to look at it, but to really understand what we're talking about here. Yeah. Okay. So by the way, if you're interested in that, well, let's just bring this up here probably. So I could imagine that some people will shoot me an email after this webinar here probably, or contact me via Twitter. You can see it here. It's at JensKlantFX. Probably this section here on my website. It's a German website, but you can find here under Ausbildung. It's the second tab here. You can find online in English. So I've created an online course on all this. It's not only that topic, but it's also on trading psychology, sentiment and trading, market structure, Dell theory, what I already presented here, and also, and most importantly, probably building a profitable trading strategy. Because some of you might wonder now, okay, how do I find this? How do you can build this? And all this is something I cover here in an online course. So if you're interested, just shoot me a mail, contact me via Twitter, or visit my website here, jk-trading.com, and then /trade like a pro. Or just visit the website, jk-trading.com, and then go here via Ausbildung and online English. And this is where you can find all information on the course if you are interested in that. So that's what I just wanted to present to you, because I promised it in the morning with the DAX long or short. I said, well, guys, I want to give you more details and a more a deeper look here. What I just meant by I'm right now short, and I'm trying to optimize my expected value here. And so this is exactly what I was talking about. So, and you can see here, we already talked about around half an hour about this topic. It's crucial, it's essential. If you want to become professional trader, or respectively, and or profitable in your trading, it's essential and crucial to really understand that. If you don't understand that, then you have lots of trouble to really make it in the trading here. And again, it's not about calling the direction of the market. I want to be honest. I don't care if the market goes up or down. As long as I have a trading approach which I know is profitable in the long run and I can easily duplicate it, well, then let's see. And the same thing, by the way, now here for the level around 11,000 and 12,900 points. So as I already said, well, we opened higher. The S&P came in higher. Where is it? Here. But now it's obviously not holding those gains anymore. So in fact, let's just see, by the way, that's also important. We have to already have a look here. And I already want to give you, because we won't make it till 2:15 p.m. GMT, which is the moment when you finally have the open range and then can formulate a setup. But I already show you how you can do this. So what you do is you look at here, the SPX open range. Okay, so therefore you just check in your chart wherever you're trading. Doesn't matter. Hopefully you're trading with JFD, but you don't need to trade here. What you need is only the numbers I'm working with here. So the high here is 2,554.2. One sec, where is it? Here. So that's the high. And where's the current low of the day? You can see it here. That's 2,546.58. So that's great, because we can already say we'll have a trade today. And in fact, 0.5. So in fact, because why do we have a trade? Because the open range already shows it's bigger than 5 points. Okay, you can see here that the open range so far is 7.75 points. That's why we have a range which is big enough. And now the thing is, next step is easy. You have to wait till, or you'll have to see where the high and the low is in the time frame between 1:30 p.m. GMT till 2:15 p.m. GMT. Okay, this is the range for the high and the low, and to define the open range. So what I did right now is I already defined the open range we see so far, but we are not yet done. We need another 25 minutes of trading. Could be that this is the range, but could be that it's a slightly bigger or wider. And then what you do, it's very simple. You look, where do we trade in relation here to this yellow line? The yellow line is the exponential moving average 10. So it's a simple moving average. No, it's an exponential moving average, but it's a simple moving average in terms of it's simple for identifying the trend. It's an exponential moving average 10. And with this exponential moving average, and if we're trading below that, we enter a short trade. If we are breaking out on the upside and we're trading above the exponential moving average 10, we take the long side. I prefer the short side here, meaning I only want to take short engagements. I don't think that we have so much potential on the upside anymore. And then you say, you enter the short once the market breaks the low of the trading range, of the open range. So let's assume it's 2,546.5. Then it's this is the short, the point where you enter the short, and you place the stop at the high of the range. That's it. So in this case, again, we have to wait, but you can easily adapt those numbers here once you have the range. And then the question is, what is our target on the downside? And this is a problem right now. What I do, and what this approach does, by the way, is it enters the trade once the market breaks out of the open range in direction of the identified advantage, and then it closes the trade at 7:50 p.m. GMT, so 10 minutes before US markets close. And not doing anything, but only holding on the short position. Then in this case, or in long position, depends on which side you trade. But you close the market; it closes automatically, and this is what generates this target here. So some people might say, "Well, I don't want to hold the position that long. I mean, I just don't know whether it really moves that aggressively lower. Probably it moves lower. Let's say here, have a look at the hourly chart. What should we look for? I think there's huge potential here, but it needs some time. I think we could easily, if the market really takes some momentum on the downside, some might say, are you kidding me? We're talking about 35 points. Yes, I think there's good potential for that. I think there's a good potential for 1% and more drop in the S&P. Why not? I mean, I was laughed at in the morning when people heard me saying, hey, I think the DAX can easily go to 12,900 points. And people were just like, are you kidding me? I mean, we are trading in a trading range of something like 25, 30, probably 35 points the last trading days. There was nothing happening, and you're going for 12,900, and boom, and you had 12,900 points. So I'm not saying that this happens very often, but I say we have such a hugely extended mode in the markets that we could easily move that much. I'm not saying that we will do that, but I think the market has already shown during European market hours that there is lots of pressure right now, and we could easily see this drop. And that's one of the reasons why I would hold on a losing, not a losing, but a short position here, and probably see a chance down to 2,510 points. Some people might say, I'm only going for a risk reward here of 2-to-1, meaning in this case, it's around 7.7 points. So I'd go for a take profit around 2,530. That's around 2-to-1, risk reward 1-to-2 here in this case. Nevertheless, I definitely hold the position open. I could imagine the market to drop as low as 2,505, 510 points, depending on whether really risk aversion comes into the market, if really nervousness is kicking in, and market participants really think, okay, well, obviously there's some trouble now. Market is heavily short volatility, heavily long equities. There's huge optimism in the market, and that could easily trigger big moves on the downside. That's exactly what I was just looking for here. When I was telling you why I think trading a break of 12,900 points is probably worth giving it a try. Since if we break below this level, again, in the case of the DAX, for example, there is nothing up to 12,680, 700 points, the July highs. So, I mean, I could easily, right now, I'd say chances that we're doing this are not that high, but they are definitely significantly increasing the moment we drop down below 12,900 points. So definitely worth at least looking at it. Yeah, and so that's in fact it on how I see the markets right now. Again, right now, I'm a little, I have a clear tendency. I mean, I'm short the DAX, and I'd really appreciate to see such a collapse here. So that's definitely something I'd like to add here. But I think I have good reasons to believe that I'm on the wrong side here. On the wrong side? No, I'm on the right side. And that I definitely give the market the room to breathe here. I could easily, well, that's also something I could take into account here. Let's have a final look at Kiwi dollar several minutes later. I have something interesting here for you too. But let's take a look back here. Some of you might probably say, hey, why don't you take the profit here? Everything's fine then. I mean, you already made a profit then of something like 70 points. Came off better like 40, 50 points yesterday, so better 120 points. So everything's fine. Yeah, but this is exactly the thing. I'm not. I think I'm not sure whether it was Harvey Specter in Suits saying that, but I really love this quote. Some guy once said, "I'm not playing this game to lose small or win small, let's say in this case, but I'm playing this game to win big." And it has nothing to do with greed, but it all comes down, and especially if you have a good reason to believe that this could play out well, it all comes down to optimize your expected value. And if you have a good argument to go with it, why not taking the chance then, and why not aiming for such a break lower? At the end, I mean, this definitely, I think it's definitely worth giving it a try. Probably I started to move the trailer stop already a little lower here, probably going, I don't know, towards 12,980 points, meaning I'd save another 80 points here, because the thing is, if the market now turns around and pushes here higher, I don't think that we're then making it towards 12,900 points, but have probably also a chance in the case of the DAX then pushing back towards 13,000. But at the end, right now, I'm definitely optimistic enough to just give it a try and just let's see whether it works out or not. Okay, so that's it on the trading side. Now, finally, let's have a look here at the Kiwi dollar. I think it's very interesting to see. Some of you might have seen. Probably. It's a huge drop in the morning. I'll just want to look up something. Okay, yes. So what's the reason for that? If some of you, I definitely know that there are several FX traders here too. So that's the reason why I want to have a final look here at the FX markets, since we only looked at equities right now. But I nevertheless want to satisfy the needs here of those FX traders too. So what happened in the Kiwi dollar? Usually it's more exotic currency pair. Most of the traders probably out there don't even look at the Kiwi dollar, but today that is one of the most interesting currencies you can definitely find. So reason for that is that the new government in New Zealand will be led by the Labour Party, and the deputy prime minister, it's Mr. Peters. His name is Mr. Peters. During the last weeks and months here, around the election, he has very, very often made the overvaluation of the Kiwi dollar a topic here, and has very often questioned the need to persist with an inflated dollar. And so the thing is that this right now is something where people say, okay, probably we're about to see a significant devaluation attack on the Kiwi dollar here from the government and in New Zealand, and that's why Kiwi is one of the biggest losers today. The thing is that usually in politics and when looking at the markets, that usually you say politics usually have short legs. I'm not sure if this is also saying in English, but in German we say politische Börsen haben kurze Beine. This is the same. Politics have short legs here. And the thing is that means nothing more than that the market is probably right now reacting to this, but usually it's not a sustainable move. The only problem I have here right now is I'm not sure whether Kiwi USD is such an attractive currency pair. But if you look at, for example, GBP NZD, it's a very, 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 very exotic currency pair. Nevertheless, I consider this attack here on the upside to be really interesting, since GBP didn't react very bullish on the inflation data on Tuesday, and also showed some losses today on the retail sales numbers coming out. And the thing is that I consider pound sterling to be really weak right now. So really, I have the feeling that pound sterling is weak. And if I then look at the Kiwi, and that this impulse here was mainly induced for political reasons, I could imagine that probably here the attack on those highs at the September and October highs and the push above that is probably not a sustainable move. So, which means I could imagine if there are signs of a diminishing a momentum on the upside, and the market really shows some signs here of a downtrend developing on the hourly chart or something, that probably a short in GBP NZD is an interesting idea. If it comes with a low risk here, and yeah, so in fact, that's it from my end. So let's just see how things develop here in the US equity markets. As you can see here, setup now is still not given. We are widening the open range. I'm sorry. Usually that's the moment here when this structure is finally done then, but so far we still have to wait another 15 minutes. But as you can see here, there's definitely pressure. There's definitely pressure building, and this is something great for my DAX trade. Let's just see whether this works out or not. I'm quite excited to see that. And yeah, if you want anything else regarding information around the markets, please contact me via Twitter, but also take the chance to listen to the morning meeting exclusively for JFD Brokers every morning at 9:30 a.m. GMT. Therefore, just look up YouTube here, and on YouTube, you just can. One sec. You can just the JFD channel, JFD Brokers channel. Yes, here. So just subscribe to the JFD Brokers, JFD Prime, JFD Wealth channel here, and yeah, listen to what I have to say in the morning meeting every morning, 9:30 a.m. GMT. And I hope that you enjoyed what I just presented to you, and I look forward to next week, Thursday, for another live trading event here around the US market opening. Happy trading. Watch your stops, and talk to you next week. I look forward to it. See you, and bye-bye.